Hello and welcome to ProutNews Weekly. Each week, we examine current events from around the world through the lens of Prout, the progressive utilization theory, developed by PR Sarko. Rather than focusing on political drama, election campaigns, or stock market fluctuations, we look at the deeper questions. Who controls the economy? Who benefits from development? And how can economic systems better serve local communities? This week's theme is microfinance and community lending. Access to credit is one of the most important factors in economic development. A farmer may have land but need financing for equipment. A shopkeeper may have customers but need capital to expand. A family may have the desire to improve their home but lack access to affordable loans. Yet, around the world, the institutions that control credit are often large commercial banks with little connection to the communities they serve. Decisions are frequently made in distant financial centers, and local needs can become secondary to profitability targets. In response, communities have developed alternatives, microfinance institutions, cooperative lending organizations, credit unions, and community owned financial institutions. This week, we examine 3 stories from Asia, Africa, and Europe that reveal both the promise and the challenges of community based finance. We begin in India. For decades, India has been one of the largest experiments in microfinance in the world. The idea behind microfinance is simple but powerful. Provide small loans to people who have traditionally been excluded from conventional banking services. Millions of borrowers, especially women, small entrepreneurs, and rural households, have gained access to capital through microfinance institutions. Many have used these loans to start businesses, purchase livestock, improve agricultural production, or generate supplemental income for their families. But recent reporting in the Economic Times highlights growing concerns with India's microfinance sector. Industry leaders are warning about increasing financial stress among borrowers, particularly in regions affected by weak agricultural conditions and uncertain incomes. The article notes concerns about rising defaults and the growing vulnerability of households carrying multiple loans. Part of the challenge is that many microfinance organizations have grown enormously over the past 2 decades. What began as a community-focused development effort have, in some cases, become very large financial enterprises serving millions of customers. As these institutions expanded, they increasingly faced pressure similar to those affecting conventional lenders: growth targets, investor expectations, competition for market share, and profitability concerns. None of this means that microfinance has failed. On the contrary, millions of people have benefited from access to small loans. But the article raises an important question. Can financial institutions maintain their social mission as they become larger and more commercialized? From a Prout perspective, this story highlights a critical distinction. Access to credit is essential, but ownership and control of financial institutions matter as well. When financial organizations have become increasingly centralized, decision-making can move further away from the communities being served. Prout argues that finance should function primarily as a tool for community development rather than simply as a mechanism for financial expansion. The lesson from India is not to reject microfinance, but to preserve its original purpose, empowering local people through access to capital while remaining accountable to community needs. Our second story comes from Kenya. A recent report highlighted the growing role that savings and credit cooperative organizations, known as SACCOs, can play in expanding financial inclusion among underserved populations. SACCOs have long been one of the most important financial institutions in Kenya. Unlike commercial banks, SACCOs are owned by their members. Members contribute savings to the organization, and those pooled resources are then used to provide loans to fellow members. The report focuses particularly on the potential for SACCOs to expand access to financial services among populations that have historically faced barriers to traditional banking. This is important because access to finance is often one of the greatest obstacles to economic participation. Without savings accounts, affordable loans, or basic financial services, individuals can struggle to start businesses, invest in education, or improve their economic circumstances. The cooperative model offers an alternative because SACCOs are owned by the people who use them, Their priorities tend to be different from those of commercial banks. Success is measured not only by profits, but also by service to members. The financial resources generated by the members remain largely connected to the communities that created them. From a Prout perspective, this represents an important example of economic democracy in practice. One of Prout's central principles is that local resources should be utilized for local benefit whenever possible. When local savings are mobilized and reinvested within local communities, economic development becomes more self-sustaining. Rather than depending entirely on outside capital, communities build their own financial capacity. Kenya's Sacco movement demonstrates how cooperative finance can strengthen economic resilience while giving ordinary people greater control over their economic future. Our final story comes from Ireland. A recent Ireland report found that Irish credit unions contributed approximately €8 million directly to community initiatives and local development activities. The report examined the activities of hundreds of credit unions operating throughout Ireland. Credit unions are financial cooperatives owned by their members. People join, save money, and collectively own the institution. Unlike conventional banks, credit unions are not primarily driven by shareholder return. Instead, they exist to provide financial services that benefit their members and communities. According to the report, Irish credit unions support a wide range of local activities, including educational programs, youth initiatives, sports organizations, charitable projects, and community development efforts. Many credit unions are also expanding lending programs that support housing improvements, energy upgrades, and local enterprise. What makes this story particularly interesting is that it demonstrates how financial institutions can serve purposes beyond lending alone. These organizations function as community anchors. They help strengthen local networks, support civic life, and reinvest wealth back into the places where it was created. From a Prout perspective, this reflects an important principle of localized economic circulation. Money generated within a community should not automatically flow outward to a distant investor and financial centers. Instead, local savings should be mobilized to meet local needs. When communities control their own financial institutions, they gain greater ability to direct investment towards priorities that actually improve the local quality of life. Irish credit unions show that financial institutions can remain financially sound while simultaneously serving broader social purposes. This week's stories reveal three different paths in the evolution of community finance. In India, we saw how microfinance has expanded opportunities for millions while also facing challenges associated with the commercialization and scale. In Kenya, we saw how cooperative finance continues to expand access to credit through member-owned institutions rooted in local communities. And in Ireland, we saw mature credit unions reinvesting millions of euros into community development and local initiatives. Together, these stories highlight a central insight of Prout. Credit is not merely a financial product, it is a form of economic power. The question is not simply whether communities have access to loans, the deeper question is who controls the institutions that provide these loans. When finance becomes concentrated in large institutions, local priorities can become secondary. When communities own and govern financial institutions themselves, capital can be directed towards local needs, local businesses, and local development. As communities around the world search for ways to build stronger and more resilient economies, cooperative finance, credit unions, and community lending institutions offer important lessons. Thank you for joining us for this edition of ProutNews Weekly. We'll see you next week as we continue exploring the stories shaping our world through the lens of economic democracy, decentralization, and human-centered development.